Good day all. Ira Epstein of Linn & Associates with your SPDR ETF video, and we are now on Wednesday, the 5th of February, 2020, and President Trump was just acquitted of both charges in the Senate, so this part of that political drama is over. On to other things. And what we're dealing with today is sort of a mixed bag. Is the coronavirus being resolved, the situation, or not? There are reports out of a university in China that they have a vaccine they think will work. We are hearing from others that isn't the case. I don't know. I know that the stock market's been on a tear, a big one to the upside, and we're watching that the risk-on environment has come back with bonds and notes selling off. And we're watching a number of other markets that are normally going up in that part. In other words, the stock market sell-off going back up as they're unwinding these risk-off trades. So let's go to the technology sector. Need I tell you, you've had a breakout right here. You haven't tried to fill that gap. Normally, you do fill gaps on charts. You can go back and look at these over and over. You'll see them. But unlike the futures market, and this is so important to understand, I don't put as much reliance in the gaps on an ETF or a SPDR chart as I do on an individual stock chart, as I do on other markets. Why? And that's because these particular markets are so often swayed by what the stock futures are doing. In other words, the S&P, the Dow, the Russell, the NASDAQ, what are those doing? And then you've got, of course, the Nikkei, and you've got others that'll work in other sectors as well. So please keep that in the back of your mind. It's very important. Futures trade from 5 p.m. Monday through Thursday until 4 p.m. and then they close for an hour basically, and they reopen for the next trading session until Friday at 4 p.m. and then they start Sunday night. Well, you miss some of that in these markets, is my point, especially in events that can be market moving. But when I put the Swingline on, it filters that for me. What the Swingline is, and this is a chart without it, the Swingline is an indicator I wrote so that I could easily look at a chart and see is it trending. The definition of an uptrend, higher lows, higher highs. Downtrend, lower highs, lower lows. No trend will in some manner have that higher high, lower low, but it's not a stepping ladder. This market's got the crystal clear stepping ladder. And what the market's done is it had for a while, and this I'm going back to Monday, lower highs, higher lows. That's no trend. Yesterday, not today, the market stepped into a trend. Now you've got the higher low, higher high, and the market's moving up and out. Where are we in relation to moving averages? Because so many traders like to use moving averages as a reference point on a chart. The ones that I use primarily in stocks are the 18-day, the 100-day, and the 200. And I do realize a lot of traders like the 50-day as well. That's okay. I can't include everything here, but in my SPDR ETF video, I do a lot more. So the market fought a battle recently against this 18-day moving average. Now, if we just visually take a look, and I'll step back here, literally since November, actually this is even before that, September, once the market got back over this number, it's had a few instances of getting under it, but it's proven to be a buying opportunity. This time around, coronavirus, the whole thing, no difference. Here's the market up and away. Where's resistance on the chart? Well, one of the indicators I like to use are Bollinger Bands. A Bollinger Band is an algorithm designed to keep the market trading within it 95% of the time. To learn more about it, you can easily go to our to Wikipedia. They'll be happy to give you a definition. But at the end of this video, I'm going to show you volumes 1 and 2 of our technical indicators, and you can get those. They'll print out that we send them as a PDF to you. I think you'll get a good understanding. Suffice to say that generally speaking, the first time you hit a Bollinger Band, the market runs into resistance. That doesn't mean it can't keep running, but it is very rare to get 5 closes over a Bollinger Band. In fact, in stock indices, futures, and I'm talking primarily, I shouldn't say indices, the stock ETFs. It's rare that you do that. The same for the spiders. So generally the first area is a resistance zone. So today we closed 99.70, just over that upper Bollinger Band. Yesterday the market hit that number. It finished at 99.12, also over it. So that's 2 days in a row. My rule of thumb is that each consecutive day over a Bollinger Band, I take away one of the 5 percentage points that John Bollinger said the market will trade within 95% of the time. It's also a sign of strength when it stays over it. Often it turns right back. I wouldn't be surprised if we get something like that here. I am not bearish. It's one thing to take some money off the table. It's another to be bearish. When we look at XLK, the tech spider, you can see you're over the Bollinger Band, getting overbought in momentum. When we look at XLI, which is the industrial sector, so let's go to this one. Here is a market that had been lower highs, lower lows. Here's my theory. Each time you hit the Bollinger Band, especially in markets like these, it's not uncommon to see the trade take some money off the table. The selling zone, again, on the charts is often, or this definitive zone, the 18-day average of closes. The market is oversold. I don't know that the pros are selling again up there. If you come back to when it hit that, you have these numbers. As long as both are over 30, the market's not oversold. The moment one of the two gets under 30, I think the market is what? At that point, oversold. Well, you went down, challenged the Bollinger Band. Did the traders get short? I don't think so. It didn't hit that 18-day average. It's falling. The 100-day average might be further support. You're pulling back into the Bollinger Bands. This is that theory, that the market will stay within it 95% of the time. Now where's the resistance? Well, while it's the 18-day average of closes, it's very oversold. That's where I was leading you with this. Then you started a rally. Coming in, well, actually in the close yesterday, you're 29.69. That's still oversold, and today you pop over. Are we in a trend anymore? No. You have a pattern of a lower low, higher high. Let's assume the market decides it really likes what it's seeing and everything. I'm not going to change my opinion. The first challenge of the upper Bollinger Band should offer the resistance. In the energy sector, suddenly the market is feeling that if the Chinese factories can get back online, can you get a pop? So we're seeing momentum doing its turn to the upside. Tonight, well, actually tomorrow morning, because that's when we'll see it open. If this number's over 20, I think a lot of the shorts bail. That doesn't mean it can't fall back down later. But when it gets over 20, it's a sign, just like when here, it got back under after being embedded, which means both numbers over 80 and you turn down. It's often a sign that a wave, be it to the upside or the downside, might, and the word is might be coming to an end. There's been a big break to the downside. Will it continue is the question. QQQ, breaking out to over the upper Bollinger Band, even with all this wild bullishness. I don't care. I look at it that it is not a buy over a Bollinger Band. Is the market in an uptrend? Absolutely. You got higher lows, higher highs, but I see support back at the 18-day average. Here's the dilemma. Overbought conditions, as I see them, are not ripe for new buying in the market by the pros. So I can see a market pulls back here and decides what it wants to do, but it's an all-time high. There is nobody that is short this market with a profit. So you start feeding on yourself at all-time highs. Is there a reason to be bearish? No. Could the market back off? Yes, but there's nothing on this chart other than being overbought that I see that's bearish. And the emerging markets. We had a break into the Bollinger Band, got to the right-hand side, fell hard. Now you've got a combination of the 100-day average and the lower Bollinger Band. Regular viewers of this know that when I get combinations of a key moving average and a Bollinger Band together, it's a warning sign that you've fallen into something important. Now, could you go lower? Sure. The 200-day average is here, but the high percentage play is off the table for a moment. Why? You're oversold. You're into a big support area. That might be reason to cover. It's certainly not reason to go long. And the market yesterday started a rally, and today, right up to that line in the sand. Again, you've got gaps in the charts. Remember, the futures are moving 300, 400 points in the Dow. You're getting wild moves in the NASDAQ. These markets pay attention to that, and they move accordingly. In the gold ETF, the GLD, Take a look at what the market did. Here's your resistance points, upper Bollinger Bands. You treat Bollinger Bands very different when you're going in a sideways action like here. You've compressed, there's no volatility left. And what a market does is when it breaks out, it's going to go volatile on you. That doesn't mean it has to stay up or down. It's going to get volatile. You've built up a pressure cooker. You went up, came back down, and now you're tiring in this run. Now, where's support? Well, I would think as a pro, if you get down to that lower Bollinger Band, you'll probably see some short covering. Is there a trend? No. You got a higher high, lower low. Battleground seems to be the 18-day average of closes. And for the first time in a while, you're under that average. You really hadn't been under it, if you come with me, back to the beginning of December. It's the first time other than this few days here that you've been able to stay under it. So we'll see if it stays that way. In the GDXJ, the junior gold miners, you've been in a downtrend. I'll take off this. Lower highs, you already had lower lows. Trend down. If you break, I'm looking for potential support. Could be lower, but I'd look at the lower Bollinger Band. To break the downtrend, you've got to take out the high right here, and that high was, if we take a look, 41.92. If you drop down, and by the way, this is Monday. I didn't do one of these for you yesterday. I'd be looking at that as potential. You hit it yesterday. Momentum down, trend down. Now I'd look for resistance on rallies back up that 18-day average. Haven't hit it, but support's still right here. When we come to the full-size miners, it's the same thing. If I back this up, I can't do it because I'm on that chart with this remote. But lower highs, lower lows. First challenge of the combination of the 100-day Bollinger Band gets a little bounce. Not a trend change, but an oversold market might be overstaying your hand temporarily there. Here is the risk off, right? See what's going on? If you break through on the TLT like the bonds and notes, it means traders are putting risk back on. The 18-day average is first support. This whole zone wouldn't surprise me if it's support, 139.73 to 141.46. However, you're no longer in an uptrend. What else happened? If we come here, this was still an embedded reading. If the red line closes under 80, often that leads to price going to the closest of the main moving averages. I wish I could say always. That wouldn't be accurate. Often it makes a run at it. How's that? So I would not be surprised tomorrow if the market makes a run there. I see layers of support here, but the trend has been broken. You're no longer with the higher lows, higher highs. And this market certainly got ahead of itself, staying over that upper Bollinger Band. In the energy ETFs, just like I've been talking, if you go to my other charts here, you're still embedded. So this market has not shown that it's ready to do anything other than a short covering rally. We had a big crossover in moving averages. Look here, this was January 30th, not long ago. Today's the 5th of Feb. You got under both numbers, and that often leads to what? The bears that follow moving averages pushing on the market, which they did. So now we're getting a bounce. That does not mean that the market's turned its trend. There's layers of resistance between 1155, 1189 to 1192. I wouldn't want to see, to keep the trend down, the pattern of 1132 taken out and break the pattern of lower highs, lower lows. In FXE, which is the euro currency versus the dollar, the popular ETF for that, lower highs. All you did is you rallied back up from the Bollinger Band to resistance points right here, the 100-day and the 18-day average. Doesn't mean you have to go to them, but you lost the embedded reading. And when you lose that reading, that's what you often do. You make a run at that number. You didn't break the trend. You still had lower highs, lower lows, and the market has been selling off now into that part. I do so many more of these because I have so many more currency ETFs that I cover in my afternoon subscriber video, which I'm going to go do right now. But if you like these indicators, then you might like to see our volumes 1 and 2 of technical indicators. We work with our friends at Futures Magazine, Modern Trader. We put these together with them, and these have been done years ago, and we helped resurrect them. They're so darn good. And it explains moving averages, the different oscillators, the way that some of them I use. Market sentiment, some people like to use that. Spreads, the importance, backwardation, what is a market going to do? Is it telling you that the front end's getting stronger? a lot of people, and I'm not one of them, I don't understand Elliott wave that well, or Gann. I can draw lines over a chart until I get blue in the face and I get confused. But there are people that understand it. To get this, go to our website. You'll see free offers in the bottom right. Click right there. You can always call our staff to get it as well. I'm Ira. You have a good day, and I'll see you tomorrow.